Now, so let's talk about equities. So when I want to start actually almost at the beginning of the year. So you and I were in Nashville, national sales meeting, and you opened up by talking about your take, the way you were looking at the equity market coming into the year, and you used sort of the three pillars approach. So I think it's fair to maybe start there.
Sure. Yeah. Look, when I started off, I said there are three pillars to the equity strategy right now. It's anchor yourself in quality, cast a wider net, and actively reduce volatility. The reasons for those three pillars were really around looking at what was scarce in the economy at that point. We saw a scarcity of growth, scarcity of capital, scarcity of certainty. So let's revisit that and see how that's changed. Growth, we have seen growth get stronger, although it's still pretty narrowly driven. We saw a lot of how much of that growth is being driven by investments now. It's AI CapEx. There's a wealth effect, right? So there still is a pretty narrow driver of growth right now. Inflation and rates, they are higher from where we started from the beginning of the year. So cost of capital still is higher. And certainty, I couldn't say that we've gotten any more certain in the markets today or in the geopolitical environment. So I'd still say these three pillars remain critical. Quality, what's really important is making sure that we're careful about defining what quality means. It's really, and we'll get into this as we go through this, but it's really about understanding a company's ability to generate returns above their cost of capital. It's not where you're always used to finding quality. Right? Casting a wider net, I think today the market remains just as concentrated as we did to start the year. Yeah, we've seen a little bit of broadening, but still very concentrated. But it's also giving you some opportunities to diversify. And then actively reducing volatility, I think that's more important there.
So in the beginning of this, we showed the story of the returns of the first half of last year and this year, and the earnings estimates changes. Obviously, earnings are the major question. So, let's go ahead and just start with that, because that's every question I get asked.
Actually, you know what? If you go back to the previous slide, I think what's really interesting here, we've got consensus earnings forecast for 27 for the next 3 years. Okay, and those are showing double-digit earnings growth. If they hold up, I went back and took a look at what average earnings growth rates were since 2000, since we started publishing that for the S&P. It averages 5.8%. Okay, if these 3 years hold up, this will be the first time ever that we've had 5 consecutive years where they've exceeded average.
Okay,
right. So this is why equity markets are up so much, because there's a lot of power in terms of this earnings growth.
And I apologize for my itchy trigger finger. I got a double punch out of that, but let's start to break down where that's coming from.
Yeah. So I think one of the things that's really interesting is if you look at the earnings side of things, it's actually how broadly we're seeing that earnings growth. Okay. Yes, it's being led by tech, by energy. That's really a lot of the AI trade. AI build out is also starting to positively impact industrials, materials, consumer services, also even financials. If you think about some of this IPO activity, that's positively impacting the capital banks, capital markets. But then there's also the top side of the K-shaped economy. We're seeing positive growth coming out of consumer discretionary. So this is a broad-based earnings vision. Okay, but I think what's interesting is on the right. The market hasn't recognized this. And this is what I mean by the market is giving you an opportunity to broaden out here. If you look at what have been the drivers of the market returns, about 80% of the market returns are still being generated by tech and semiconductors.
Well, I mean, that was the story of the tech bubble too, right? Is you have the buildup in all the tech behavior, you have it blowing up. But the real story, remember, it was new economy, old economy.
Yeah.
But what actually is the reality is that it's the old economy that adopts the tech of the new economy, and then it accretes through.
That's right. Yeah, and so I think the big question that we have today is there's all this spending that's going on in tech. And actually, if you go to the next slide, I think this is really interesting. We know, if you look at forecasts for CapEx spending among the hyperscalers, there's $1 trillion being forecast for next year, close to $2 trillion over the next number of years. Okay, what has that done to hyperscalers? It has turned what has been traditionally very, very healthy, positive free cash flow to the next years. We're getting to negative free cash flow for these hyperscalers,
Mm.
right? That's Meta, Microsoft, Google. So these are enormous companies that had huge cash flow generation, and that has now gone away. But on the other side of the ledger, the beneficiaries of this is really, you could see the semiconductors, the memory chip makers. Look how strong that free cash flow has become. They've really absorbed it. And so, again, another cause of this broadening. But I think it does call into question is how profitable is all of this CapEx going to be? And where's the steady state? There's schools of thought, which is that we're seeing kind of a pig in the python in terms of how much CapEx is being spent because people are just experimenting. You have this concept called token maxing. And that's really where managers were incentivizing their employees by, I just want to see how much AI you can use. And so you could see that over the past few quarters, the token usage, the cost of using AI skyrocketed. But now, as we're starting to see the bills for that, we are starting to see, let's pull back a little bit, and how do we optimize this?
So can I introduce token budgeting as the newest?
Absolutely.
All right, so obviously AI is a huge part of this, but you talked about all these other spaces, and I'm, as you know, I'm completely aligned with that take. So let's start to jump into those.
Yeah, I think this chart on the left is fascinating. Look, if you remember back in the glory days, in the easy days, right? If there ever was these days, you could set it and forget it. And that was basically you put your money into a quality growth portfolio, you let that compound over time, and over a decade, that actually led to some really great gains. But over the last number of years, it's become much, much harder. And why is that? Is if you look at what we're showing here is really green shows the factors that are in favor, red is the factors that are out of favor. And just the volatility and the velocity that the market is switching back and forth between momentum, value, growth, low volatility has very much accelerated. That means to me that diversification is more important than ever. And if you look to the right, if you look at the second quarter versus the first quarter, just the change in leadership. First quarter we saw energy, utilities, materials as being your leaders, and now it's technology, consumer discretionary, consumer services. Right, so just the velocity that the market changes over, and I think again goes back to why having a more balanced portfolio and making sure you're expressing all of your factors is more important.
Even a classic consumer space, consumer staples, quarter over quarter. Well, I mean, same idea, but it's fascinating.
So much for us area, right?
Yeah, right. Yeah, exactly. That was my point.
Yeah. So I think one of the areas where we've been underinvested as an entire investment community has been value equities, and that really comes out of, I think, value earned a reputation post the global financial crisis as being a very highly cyclical. Whenever the market melts down, value is going to underperform significantly, right? But look at what's happened over the last 2 years. We've had the tariff shock, we've had the software sell-off, we've had the Iran war set in. And in each of those cases, the market drew down significantly. And what was the best performing strategy that held up and protected your assets the most? It was value. And as a result of that, you can see over the last couple of years, value has actually outperformed other styles of investing.
Look, I talk a lot about better betas. These are factors or parts of the market that have great sequence of returns. And we can talk about quality, we can talk div growth, we can talk low vol. Value is sort of the original better beta. When you were creating the conference three factor, that's what you came up with. So this is just one not to sleep on, because post GFC, it did go to sleep in terms of attention.
That's right.
And value also plays a role even in the supply chain of AI. So let's just say a few more things on value and we keep on.
Look, I think actually, there's a why behind why value has done so much better. And I think there's really two things that you get out of value. First of all, it is the fact that value benefits from this broadening. That very broadening that we saw. There is a lot of AI insulated industries. There's much more in value than there is in growth. And so if the central question is, well, will AI do well or not? And if you have to bet everything on red, that's not usually a winning strategy. This gives you an opportunity to look at things like agriculture and travel and expenses, experiences to really diversify your portfolio. And I think the other way that you can cast a wider net, not just value, but go outside the U.S.
Yeah.
Okay, and look, I think again the market's giving you an opportunity to diversify your portfolio, and I think here you're getting two opportunities. You're getting the opportunity to reduce risk and get other return exposures. You can see you reduce the risk by just introducing lower correlated assets, and that's the international markets. The industry composition and the makeup of international markets is very different from the U.S. Whereas in the U.S. you get 50% in technology. Outside of the U.S. you get financials, industrials, and banking. And so as a result of that, just get many more ways of expressing yourself, and we're seeing that in returns as well.
Same thing. It's like value, another extension of value, places that most investors I didn't get asked about for years.
Right. Yeah. So look, I think the other big question that we have is what happens if AI slows down, the CapEx slows down? What happens if these companies don't start to realize profits soon? They can pull back on CapEx. Given the amount of spending that they've had, I think that will have a meaningful impact on the economy. And you could see the economy slow as a result of that, right? And so I still think this is why I think actively reducing your volatility is still a very important part of the equity strategy. And what we did was we looked at in the past, if you saw just if technology were to underperform by 500 basis points, and we looked at various episodes over the last 30 years, each time technology underperforms by a little bit, the other side of the coin is defensive stocks. So if we look at the min-vol strategy, you can see that annualized, whenever technology underperforms by that 500 basis points, min-vol actually outperforms by some 18.5% on an annualized basis.
And there's a decent amount of potential energy in low vol, because if we were to go back to that Christmas tree red and green, of all of those that were out of favor the most with the biggest red chunks, it's been low vol.
That's right.
So this is another space to think about. It's post-COVID been one of those that have really been a bit challenged, but as Nelson points out, don't go to sleep on something that's protective and defensive and generates reasonable cash flows. Just give that a look as one thing to consider.
Sure.
And so let's put it together in the equity playbook some.
Yeah, look, I think if we think about the issue with cap-weighted markets today, it's really about the outcome just relies too heavily on answering that one question: is will AI generate that profitability? I think that AI will have an enormous impact on the economy, but it's just too early to know how that's going to play out. And I think, just think about the internet. It took more than 10 years before, after the bubble burst, before we started to see companies really start to formulate. Okay, so I still think coming back to our three pillars, using quality as an anchor, casting a wider net, and actively reducing volatility, still very important. Where we're seeing, where can we find companies that where they're generating higher returns on invested capital than weighted average cost of capital? We're seeing that in a lot of thematic equities, aerospace and defense, a lot of your AI enablers. You can also find quality in areas where you typically haven't looked before, like industrials and financials. Casting a wider net, value international is really important. And look, if AI spending meaningfully slows down, those defense sectors can really help you out.